you look at previous crashes like 87 or 2000 or 2008, Bank of America estimates that between 2 and 7% of AUM gets withdrawn out of funds, and that's what causes the crash. Now, passive had no outflows in 2020, none whatsoever. It was just that the kind of consistent trickled-out buying wasn't enough to stop the selling, and it fell quite quickly. And then when target date funds came in later in the month, they basically pushed it back up again. But I can see a time, where either foreigners or baby boomers as they retire, become net sellers of equities, and they've been net buyers throughout for decades now. That's when you get to the situation where you might end up in a net outflow situation for passive. And then the question is, well, where's the bid? Because we've broken the link between the fundamentals of the company and the stock, you get the situation where this discrepancy might actually be quite large.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Nick Van Rensburg. He's a macro strategist with a particular interest in tail risks. He joined financial markets in 1996 at a bank trading equities and later equity derivatives. He spent 10 years at South Africa's first hedge fund, where he started covering commodities, which exposed him to macro. Today we talk about the dangers of passive investing. Nick, how are you? So nice to see you.
I'm good, thank you very much. How are you?
I'm doing very well. I'm very excited for this conversation. I mentioned to you that I'm curious about passive investing because it's something that a lot of people fell in love with. And as a contrarian, I want to hear the other opinions. And I'm very intrigued by the work you've done. I know you've done a lot of research and put in a lot of thought into understanding the other side of passive investing. And I came across your writing and we connected a few months ago. And I was really looking forward to having you on the show and diving deeper into what passive investing is and what are some of the dangers that we should be aware of. But before we get started on the topic, I like to ask my guests about the early days, if you indulge me. And I ask them about childhood upbringing and how you think that time shaped you, your relationship with money, and the career path that you chose.
So I'd say I had a public school education, and I had to work for money, so I didn't get pocket money. And I think that's one of the things I had to unlearn later in markets, because you can, it's not really about the quantum of the work that you do, it's about the quality of the work you do. Buffett can read an annual report much faster than the rest of us. It's just something that he does over an extended period of time. So working harder is not always the answer. Sometimes you just have to sit and wait and be patient, while markets do what they do and so forth. So I'd say that's something I probably had to teach myself. And then I think one of the other key lessons is I started an investment club when I was at university with some friends. And it was really interesting to see how everyone else interacted with money and with investment ideas and the different risk tolerances. So it kind of gave me some idea of how a market is made up. You've got these people, they're all my friends, right? And yet they were so different in their risk tolerance. One or two were trading with bursary money. Some of them were working for their money, some had family money, and the risk tolerances were so different. So that was a fascinating experience. We didn't make much money, but we had a lot of fun and we learned a lot of lessons. And then when I got into markets, obviously, initially I started off in a private client stockbroking business and then prop trading, equity derivatives. So you see all the different kind of mechanics that influence the market. And I learned a little bit about behavioral finance, which I always found very interesting and ended up doing a course on it later. And then I think for the topic of today, I did a sabbatical in 2009 after I got taught about tail risks in the subprime crisis. I never knew what a ninja loan was, and then I learned the hard way what a ninja loan was. We just call it a donation, and it's actually got a tax liability attached to it, but in America, apparently not. So I did this complexity theory course with Professor Scott Page. The teaching company had all these DVDs, and they had huge 60% sales, so I bought a whole bunch of it and did a bunch of these courses. And in complexity theory, he basically taught me, that it's a little bit like a bunch of dials. A complex system, you want things kind of near the middle. It's a little bit like bass and treble, bass and treble on a DJ thing. You don't want it all the way on the one side because a light switch is a simple system, and then a complex system has got multiple dials and they kind of switch, at different stages. And that's something that markets need. They need that kind of diversity and different settings to it, and people who make decisions based on different for different reasons and different time frames and the like. So so that's kind of I'd say behavioral finance has been very interesting to me. Positioning is really interesting, especially when it comes to tail risk. Understanding where everyone is very, very long, or where they don't own anything, like we've seen in the last couple of weeks in China. No one owned it, and that's why it went up so much in such a short space of time. If it was a very heavily owned market, it wouldn't go up nearly that much. Those are the kind of things that really intrigue me. Yeah.
It's fascinating because we think of investing as a very, almost like science. We can figure out the formula, we can value the stock, there are complex spreadsheets, but we forget the human element that you bring up, the behavioral dimension to it. And I found it really intriguing. What you brought up is that your friends responded to risk in different ways and money as such in different ways. And I see it with my clients. I manage money for families, and I realize as much as it is important for me to understand the investments that are in the portfolio, I have to understand the people whose money I manage. And we can sit in a room on a nice day and talk about risk and a downside and a drawdown, but actually living through it together and being on the phone with a client in March of 2020, nothing replaces that. That's not something they teach you in a classroom.
Yeah.
Right? Because in theory, 10% drawdown, that's fine. How nobody really cares. But then when it's actually happening, you picture the next 10% and the next 10%, and you start to panic and you start to feel uncomfortable. And I spoke with people in March of 2020 that I have a lot of respect for, that scared themselves out of the market to the point that they liquidated their assets at the low of 2020. And they had all the experience and many more decades than I have. I've been doing it for 20 years. And I noticed that the emotional side shows up and may surprise you. So it's very important to be aware of it. And I'm sure it's going to come up in this conversation again, but I find it fascinating, and I'm glad you brought it up. We'll be talking about passive investing today. So for the benefit of the audience, since you've done so much research, could you give us a quick history of how passive investing even came about? And what is it really?
So I think back in the 70s when Jack Bogle, the founder of Vanguard, started it, he was quite upset about the fees that active managers were charging. And I'm sure the fees were 1 to 3%, like very high levels compared to today. And he decided, obviously, just to create a product for the everyday investor, to do it at low fees. And those fees have been coming down. But what it's also done is it's dragged down active fees. So as a result, today, even the active management industry is relatively cheap compared to what it was back then. And passive has grown. It probably started off, I'd say in the 90s, it was in the low single-digit percentages, and we're now up to, Bloomberg estimates, we're up to 60% of US mutual funds are passive today. So it's become the dominant player. If you listen to people like Mike Green, he'd say it a little bit lower. I think he thinks it's in the 40s, if you count probably a broader universe. But it is, no doubt, it's become a very large, percentage. And the benefit for investors have been that it's a very low-cost way of saving. So if you're saving for 30 years, saving an extra 1 or 2% a year is a very significant saving, and it makes a big difference, over a 30-year period to compound with an extra 1 or 2% of capital per annum. So, so I think it's one of those kind of things it's very obvious what the benefits, should be for passive. It is a very low-cost way of investing, and you never have to worry about, you're never going to outperform the index, but you're also never going to underperform the index. And for, some reason, people want to perform like or more than the index, which is obviously a decision that's taken.
And I think there is a valid argument to be made that if you want to invest, as in own businesses, because that's how I see stock investing, and you don't have the time, ability, skill, interest in finding individual ideas, I think it's a pretty good way to participate by owning a benchmark. So when you talk about the idea behind it, it's actually very helpful to think of it as I could own a large collection, whether it's 500 or even 2,000 businesses in the US or globally or any particular market. And I should be diversified. I should own a little bit of everything, kind of a Noah's Ark investing, 2 of each. And as you said, the costs are low. And what is lost in that conversation, that you really have to piggyback on somebody, and that somebody is the active management. And I want to ask you about something you bring up in one of your essays, that passive investing is a bubble crash machine. And let's start with that point. But there's something that happens when too many people are doing the same thing. They can lead to consequences that are not as favorable. Can we dive in?
Sure. I mean, there was a great book, The Wisdom of Crowds, and it talks about when does a crowd become more intelligent than the individual members of the crowd? And one of the key issues is that you've got to have independence of thought. Because if we're all thinking the same, we're all making the same decision. So every bubble is essentially we all thinking the same. And similar is a crash, because a crash is just a reverse bubble. We were all very bearish in 2009 and very bullish in 2007 or 8. I'd say, the majority of people. So that when you lose the independence of thought, you basically get into a situation where you get into bubbles or crashes, because it becomes self-reinforcing and pro-cyclical. There's no counter-cyclical force. I want to buy, you want to buy, I want to buy faster than you, that type of thing. And that's kind of how it just keeps pushing. So there's this level of urgency because we all got the same view. And I think we saw that in 2020. Basically, the COVID situation is something which I noticed around maybe the 16th of January, somewhere around there. And on the 25th of January, there was a huge situation in Wuhan where they had about 100,000 people at this international fair. They sent them all home all over the world, and then they shut the borders. And I thought that was quite strange, because you've got this, thing, and first they let the 100,000 people go home, and then they shut the borders. And as you could then see, the numbers were just going up in China, and they were welding people into apartments and the like. And the market just ignored all of this, completely ignored it. And I think that's kind of one of the issues with passive is you don't have a translation of reality into stocks. Because what passive does is it makes you an asset allocator. There's no link between the stock, and the company. So we had this period where this huge run up, and then you basically had one of the fastest crashes outside of 1987 in March, once the market finally caught up to it. And then you had the largest stimulus in human history, and then the fastest recovery. So you did this kind of V shape. So if you went on holiday for a month, you wouldn't even know that anything happened. And the worst case was basically that, if you were sitting in front of your screen, you could think, this might be, I remember reading a book on the Great Depression and thinking like, well, I've never really thought that an economy, a global economy, could come to a standstill. It's just not something we think of it as slowing. That's what a depression is, but not standing still. So it was like quite an interesting time to obviously think through all of these things. And what was really interesting is just how steep it went down, because there were just no bids. And I think that's one of the kind of outcomes of passive, is that because everyone is the same way, when the active selling or anyone panicking or people pulling money out of funds or whatever it might be overwhelms the daily passive flow, you go no bid quite quickly. And I think the market fell about, I think it was 16% in 9 days or 23% in 9 days, something like that. And then it rallied quite quickly after the huge stimulus. Now, what I can see going forward is that, as passive keeps building, that you're going to build a bigger and bigger bubble. But the cost of passive is not actually just the fees. You've got to almost look at it as a life cycle cost. And because we've not gone through a life cycle, we don't actually know what the total cost is. And I think this is the point I'm trying to make with the article, is that, we might wake up one day in 2026 or 2030 or 2040, and whatever we thought was in our pension funds just disappear, because the passive then all of a sudden, for the first time ever, gets a net outflow. And if you look at previous crashes like 87 or 2000 or 2008, Bank of America estimates that between 2 and 7% of AUM gets withdrawn out of funds, and that's what causes the crash. Now, passive had no outflows in 2020, none whatsoever. It was just that the kind of consistent trickled out buying wasn't enough to stop the selling, and it fell quite quickly. And then when target date funds came in later in the month, they basically pushed it back up again. But I can see a time, where either foreigners or baby boomers, as they retire, become net sellers of equities, and they've been net buyers throughout for decades now. That's when you get to the situation where you might end up in a net outflow situation for passive. And then the question is, well, where's the bid? Because we've broken the link between the fundamentals of the company and the stock, you get the situation where this discrepancy might actually be quite large. I've got a stock example, Apple. So those are the kind of things that, you think, well, how does it happen? So that you get to this kind of size. And the issue is it's basically one of the largest companies in the S&P, but it's also one of the largest companies in the world. And it's the largest company in the NASDAQ and the largest company in the XLK tech ETF. And it's an AI play, and it's whatever it might be. So there's this Venn diagram where Apple sits in the middle, and you've got all these things packed around it where when they get flows, it all feeds back, ends up in Apple, Microsoft, Nvidia, and the like, which is, brings to the point where we don't have a very diversified index anymore. One of the benefits of passive is that you'll always capture the winners. Like whatever is in the S&P 500 that becomes a winner one day. So let's say Palantir today is a smaller company, but maybe one day it's a big winner. It'll be there. Where as an active manager, I might miss Palantir because I might say it's always too expensive. So that's one of the benefits of passive. But what it also does, is you get to the situation where these companies are just very, very large and not that diversified.
You're touching on so many interesting points, and I'll just bring up for the benefit of the audience, any stock mentioned in this conversation is no recommendation in either direction. So do your own research and see if it makes sense from your perspective. I think it goes without saying, but I'll say it again. But you bring up so many fascinating, and I kind of want to take one layer at a time. You have a quote in one of your essays that I want to bring up from Jack Bogle himself. And he said in 2017, if everybody indexed, the only word you could use is chaos, catastrophe. And then he said there would be no trading. There would be no way to convert a stream of income into a pile of capital or a pile of capital into a stream of income. The markets would fail. which is fascinating that it comes from the man who, we believe that gave us passive investing. And I don't know the term for it, but there are certain ideas in life that if I do it and my friends do it, it's great. But if all of us do it, there are bigger consequences. And I'm thinking, for example, there's this FIRE movement, Financial Independence, Retire Early, which basically believes that you live at a very low spending level and you save so much. I'm sure you're familiar with it. And if all of us actually did it, right?
Catastrophic.
There will be consequences for the economy. If all of us cut our spending by 80% and we really just cooked at home, grew our own carrots, and took a bicycle to work, and so on. It would be a different economy. I think that's the idea. It would be a different economy. So there are moments where you feel like, oh, this is such a great idea, but if all of us do it, it's no longer such a great idea. And I'm sure there's a term for it and it escapes me. Maybe you know the term for it. But here with passive investing, conceptually, it's a great idea, right? You have this market, you have all those stocks listed, and you don't have to do the work. Somebody else is valuing them, visiting the companies, reading the 10Ks, deciding, just as you mentioned, the wisdom of the crowds. It's James Surowiecki that wrote the book. And in that book, he talks about a market, a square in town. And to the extent I remember the story. And there's a bull standing on a stage, and people have to guess the weight of the bull. But everybody votes independently without consulting their neighbor what the weight would be. So you have the diversity, and you have a variety of opinions. So then the actual average of all the votes is very close to the actual weight of the bull. He's making a point that market in that sense works. Now, in a market where you say that 60% is passive, which is basically hands off the wheel, I'm going to go wherever this market takes me, then you have also benchmark huggers. And that's a concept that has existed for a while, where people want to be so close to the benchmark so they don't fall behind, because if they do, they lose assets. It's a very real risk when you're running, big institutional money. So you have investors like that. And I saw this, and I don't know how representative it is, but the most held stocks by hedge funds, and hedge funds are considered, very active, and they're making decisions and evaluating. And I noticed this massive overlap among major hedge funds with the benchmarks. So the 5 stocks or the 7 stocks, they all hold them, and they hold more of them than they're even represented in the benchmark. The weights are bigger. So it made me think, who is actually truly deciding the weight of the bull here and really making a contrarian bet? And the group might be too small, as Bogle was trying to point out, to create some sort of a working, not efficient, but a working market where you could actually come up with a more accurate estimate of the risk reward, which is something that we expect from the markets. Is that how you think about it?
Yeah, I think you want a market to have a diversity of participants. And the reason for that is like, if I want to sell to someone. Mm-hmm. We can't all sell together. We can't all buy together. So you need people with opposing views, and it might be because they've got a different time frame. I might say I'm going to sell Apple because of the beliefs I've gave to you. Warren Buffett might say he likes it because his grandkids like iPhones, or whatever the reason might be. And I think that's the issue. And he might have a completely different time frame from me. So I think you need people with different time frames, with different valuation methodologies or decision methodologies, even if it's not valuation based. And and then you need day traders. I might think, well, it's crazy to day trade Apple or something. The reality is, like, there's a bunch of people that do it, and they provide liquidity for everyone else. Mm-hmm. So the result of it is you need this diversity. And when 60% is basically functionally the same decision maker, it's got the same decision rule, so you can think of it as all as one. The diversity has gone down quite significantly. And then for me to beat passive or to beat the index, I need to be more pro-cyclical, which is what passive is. Otherwise, I won't be able to outperform, because if I'm always shorting or selling NVIDIA, I'm going to underperform, and I can underperform in a very big way. So if you think of NVIDIA this year, I think the range is probably somewhere between $75 and $145. And this is now one of the top 3 largest companies. So it's a super volatile stock that is in the top 3 largest companies in the world, basically. So, those are the kind of things I think that become interesting over time, is the fact that you get this concentration because the same shares are on multiple indices. And I was listening to a talk the other day on Japan, and they were saying that in Japan they've got these NISA accounts, like tax-free savings accounts. And you can analyze the top 10, instruments that are in there. And the top one is the All Country World Index, which basically has got, Apple, Microsoft, and Nvidia as their top 3 picks. And then Nvidia is a single stock in the top 10. And so may Microsoft be. So you've got this kind of duplication. They're buying the same things. And you would have thought, there would be like 10 different things, or there'd be a bunch of different ETFs covering different countries or world, the world, or maybe different sectors or something. But it's actually, there's quite a lot of duplication. And I think what's happened over the last couple of years is, and this is maybe one point that's quite important to make. In passive, we've got the ETFs like the SPY or the QQQ, the NASDAQ 100. And those are the things we can see. And then we can also see the Vanguard passive fund or the BlackRock iShares passive fund and the like. And then there's a whole host of money behind the scenes which we cannot see. And that would be people like sovereign wealth funds, which manage, I think, somewhere between $12 trillion, somewhere around there. And I've spoken to 3 separate sovereign wealth funds, and they basically say the bulk of our money we're going to invest passively. And the reason why is when we want to make asset reallocation decisions, it's very quick to just sell America and buy Europe or whatever we want to do. Mm-hmm. Where if it was invested with a bunch of funds, we would send you a redemption form. There's a whole process that goes through, and we'll get our money in 45 days. So that, for that reason, they're also very, very large passive investors. And I mean, one of the, there's probably about 3 separate events which really crystallized the whole passive thing for me. And one of it was a big endowment, and one of the big sovereign wealth funds told me they don't even allocate any money actively in America. They only do it in the rest of the world where they believe there's still alpha to be had. But they say they don't experience any alpha in America, and it's because there's so many players, it's really, really hard to find it. Now, that's kind of unfortunate because I get the whole argument against active, but you do need someone to link the fundamentals of the company to the stock. Mm-hmm. And that might just be a romantic idea I've got. But, it's the kind of...
I'm with you. I'm with
you. So and I used to love, going, seeing companies and learning about companies and the like. And, the reason why the Jack Bogle quote was such a standout for me in 2017 is because I used to look at companies and we'd meet with management. Mm-hmm. And if they say something like, the business is going really badly and you shouldn't buy the shares, you kind of go, what? That never happens. They're always telling you it's a good story and, we're going to make the numbers and all this kind of stuff. And if you look at it, especially in the US, like it's basically a quarterly sales pitch. If you're a CEO and you're not a salesman, you probably will get fired. Yeah. And every quarter we have the thing about the analysts got the expectations up there, mm-hmm. and then IR takes it down, and then the earnings comes out and it's a beat. Mm-hmm. And then the algos can quickly buy the shares and all that kind of thing. So it's kind of unfortunate that it's developed that way, but I mean, that's the reality and we have to adapt. Now, I mean, most of the people I've worked with over time has outperformed the market over time. So, you just basically adapt. You've got to find what works and what doesn't work and go accordingly. One of my colleagues at Milkwood Capital, Reese, he's a bottom-up, very much a value type investor. And he's come to the conclusion that you can only invest in bottom-up companies, smaller companies, if the company can do its own share buybacks or increase its dividends, or kind of like create a value unlock by itself. Where if you're hoping that some other fund is one day going to buy the shares, if you buy it at a 5p and sell it at 8p, somebody needs to come and buy it. And those people mm-hmm. are just not there anymore, which is a point that David Einhorn also made recently. You can't expect that some other value investor is going to buy your shares at a 30 or 50% premium, because the value portion of the market is shrinking. Mm-hmm. Because value, is counter-cyclical. We stand in the way of the buyers when they get out of hand, and we basically stand in the way of the sellers when the market falls too far. Right. Where the kind of growth or momentum investors are selling into the depths and buying into the highs. And it's worked incredibly well. I mean, a pro-cyclical strategy in America has been super successful. And I think the fact that any other strategy hasn't really, or counter-cyclical strategy hasn't worked means that the diversity of pro-cyclical and counter-cyclical players have changed. There's far more pro-cyclical, which is why you get all the closet indexes, because it's the only way you're going to keep up with the indexes if you've got a combination of, the Max 7 type stocks. You might have a slight different view and say, I like this one better than that one or whatever, but they're all there.
It's a self-fulfilling prophecy. I have this idea that anybody can buy a stock. Very few people can hold the stock. And the point I'm trying to make is that in tough times, what I've learned managing money for people is the fact that I know the holdings that we have. That gives me peace of mind and gives my clients peace of mind. And on some level, and we talked about behavioral side of it and psychology, it's very important to me because these are the moments where I feel like I'm adding a lot of value that we actually will hold on or to even, add or buy to holdings that we know. I know the balance sheets. I know who is running them. I know what kind of strategy they have. Yes, the prices drop in a time like March of 2020, and I'm sure we'll experience something like that in the next decade or two. I have little doubt about that. That's the nature of the market. But can you actually hold on to it? And holding on to an index, I notice it's actually very tricky for people because what is it that you own? You own all of it, but within that all, you don't really have that kind of conviction that somebody that holds. It helps me. I don't know if it helps everybody. It helps me to know what I own. So that's the big difference that I see. But you point out a number of issues, and one of them that I think is very important is that you describe it as a single decision investing. You just buy, you keep on adding, and it kind of makes sense when you're thinking of, I have a retirement account, I'm going to be adding $1,000 every month, and after 30 years, I'll take the money out. But then you say that's great, but it makes a very complex system fragile. It destroys the mean reversion. Can you talk about that? How that has consequences of that nature?
Yeah, so the fact that you've got lesser participant diversity, the thing is today, let's say I'm 22 today and I'm going to start saving and put my $1,000 into the account every month. Today, 60% of mutual funds are passive, but what will it be in 30 years' time when I want to retire? It'll be a Jack Bogle's number, right?
Right.
So I'm going to be sailing into the chaos and the catastrophe. Now, people who started saving 30 years ago are probably lucky that today they can still get out in some way, shape, or form. But it seems inevitable to me that as you're getting more and more towards a single decision machine, it becomes less and less likely that you're going to get full value or the current values for it. While it's increasing, it creates this kind of hyperbole. And I think at some point the back end of that is that it falls off the cliff. So for me, it's inevitable that the Fed will one day buy equities, the same way as what the Japanese, the BOJ bought ETFs and the like. The question is, are they going to be able to do it in enough size? Because the US market is so much larger than GDP. And, you can say, well, the central bank is not a function of GDP, but it kind of is, because money supply is a function of GDP. So I think those are the kind of things that I would worry about longer term. And I mean, it's probably worth talking about true free float, because this kind of explains why this is a problem. So let's say you and I started a business and we're going to go list it, and we each own 15% of the company. Let's say the business is large enough, it's now going to go into some index. The MSCI or S&P or whoever the index provider is will exclude our 30% from the free float. So if it's got a $10 million value, it'll say $7 million is the market cap that's relevant for the index.
Right.
And in the case of passive, that is not the case. So functionally, I don't trade the shares. Maybe every year I'll sell a little bit or something because I want to buy a boat or something, whatever, or go to
nice
Omaha
car
or something.
So, we don't judge.
So so it's very little. I trade very little with that 15%. Now, similarly, if you look at Vanguard and BlackRock and State Street and the like, and then all the other passive money that's not counted being, sovereign wealth funds and the like, if you add all of that up, that'll also be 30% or more. It's now a larger number than 30%. But that is not excluded from the free float, even though it also does not trade. So for them, they'll get the full 10 million rand index, value weighting in the index. The free float, their free float weighting will be 100%, and for us it'll be 70%. Now the reality is we might trade the same as what BlackRock trades, like almost never. The churn is about 2%. When I looked into this in 2017, Morgan Stanley said that passive funds were trading about that 2% fund churn per year, and that's essentially the quarterly rebalances plus the annual inflows. So the rebalances are tiny, and they probably had about a 2% annual inflow at the time. Long-only active funds would be about 40%, and then hedge funds were like 300% at the time, and I'm not sure what that would be today. So basically, when you take money from an active manager, you take it from the 40% churn down to the 2% churn. So it calcifies the free float.
Right.
And what it then means is, if you get allocated for, let's say, for argument's sake, the free float of $1 trillion company is, there's a founder that's got $100 billion worth of shares, that's excluded, and then you've got another 30% that's passive. It's going to get allocated money as if it's got a 900 billion free float, but it actually only has a 600 billion free float. So you're allocating 50% more money to the share than what you should be, because it's just not available. BlackRock's not selling the shares to you. It's not available. So as you kind of calcifies, the free float, what happens is 2% of, 100% free float company is 2%. But if the free float's only 40%, that's 5% inflow, not a 2% inflow.
Right.
And as you go to 70, it's 2 over 30. And then it's 2 over 20 and 2 over 10. And that's the chaos, that Jack Bogle talks about. Because if an annual 2% inflow is 20% of the free float, the shares would go wild, as you can imagine. Similarly, if you then get an outflow, 2% over 10 is a very large overhang. And that's the kind of thing that basically we go up the mountain, but we will come down it again. Because at some point, somebody's going to retire or sell. Now, that could happen because of recession. It could happen because foreigners decide they're going to allocate less money to the US and more to the rest of the world. I mean, US equities are now 65% of the global equity market cap, according to MSCI All Country World Index. So on that kind of basis, if they say, well, that's a lot to one country, and yes, these are great companies, but the rest of the world's actually more global. So let's say the rest of the world starts growing at a higher rate or whatever it might be, they might allocate money away, they become sellers. That will probably be a passive sell, and there might be some outflows then. And then probably the largest one. So if you look at the US, about $55 trillion market cap, about 13 trillion is owned by foreigners, so call it a quarter. Okay, so between 20 and 25%. And then by my estimation, about $28 trillion, or about half, is owned by baby boomers and silent generation. So the people over the age of 60. And they're going to be less risk tolerant as they get older. I mean, my dad is 80 and I can see it. His risk tolerance has definitely gone down. And so the next correction you have, people are going to panic a little bit more than what they would have 5 years ago or 10 years ago or 20 years ago. And I like looking at this through the lens of the boomers, because they were roughly 42 in the dot-com bubble, so they still had quite a long time to make the money back. And in 2008, they were roughly 50, early 50s, so they still had time to make the money back. When the median age is now probably about 67, they don't have much time to make it back, because at 67, you are in retirement. You're not contributing anymore, and you're getting closer to the point where you have to start redeeming. So that redemption, I think, will end up in net outflows, and we are there already. And one of the interesting things that, the common comeback to this argument is people would say, yes, but we've always had people retire. Why is it so different? And the reason why it's different is this is the wealthiest generation in human history. So baby boomers, their peak wealth at the moment is roughly 3 times what the preceding wealthiest generation was. 3x. And that's quite significant. I mean, it's actually about 300% of US GDP is the wealth of baby boomers. So I think this could be a very interesting thing, in the sense that I think there'll probably be an equity overhang over time. And against that, they might actually also be quite a big spender on services, because they've always been a big spending cohort through their entire lives. So you might find that they sell equities or they give the money to, whatever assets. At some point, I think they'll move it into bonds. It seems kind of obvious. The way the US budget deficit's going, at some point, I would do financial repression if I was the Treasury and try and, force them into the bond market to pay for the debt or to take up the debt. And that, that money will probably have to come from equities. So those are the kind of things that could cause a net outflow out of passive at some point in time. So I think it's inevitable it will happen. It's just a question of when, and that's what we don't know. And when it does happen, my prediction, and I think Mike Green's prediction as well, is that the market can go down much more than what people can imagine, because it's this, it's the same decision maker trading in the opposite direction. The constant bid disappears. I think Mike Green's actually gave quite a good example. He said, like, if you imagine bidding on some piece of art, and it's quite frenzied, and the paddles are up. And then you get so excited and you put up that paddle, and the next thing is no one's paddles are up. It's that moment, where you realize, okay, well, we're all in the same situation and none of us really want this thing. It just felt very exciting in the moment. That's when you start asking questions like, should this company be on a 35 times earnings? What's going to happen in the next 3.5 decades? It's a long time. At the moment, those questions aren't being asked, in my view.
You beautifully presented it from a micro perspective, an individual stock and its float, and how we can misunderstand the free float when you have a lot of participation of passive, all the way to a macro picture, which is who has been the buyer, right? And who has been really putting money into the market through the passive funds for various ways, but basically lifelong investing in a passive way. And we're used to them putting more money and more money and more money, and we reach a point where, well, they do need the money and they might want to be the ones selling, or it's enough if they're not buying enough. I have a couple of thoughts here as I'm listening to you. One is that phenomenon that I'm seeing that I don't remember seeing as much in the past, where you see a gap down, even in larger stocks, where the stocks drop 20-25% in a day or two. And obviously, it's driven by earnings disappointment and so on. But when you actually look closer, and as a stock analyst by training here, you could have seen the weakness appearing, but it looks like the market ignores for the longest time that weakness appearing. Growth is slowing down, the margins get compressed, there are some headwinds. These days we had some companies with input costs going up and they can't push along the pricing. So there's a million things you notice if you actually read the transcript and look at the earnings. And I'm surprised at times how long it takes for the market to recognize it. And then the market recognizes sort of once in a big gap down. It almost feels like you have this market that's active, and then it's almost like some stocks are trading by appointment. It's like we don't adjust the price until we really, really have to adjust the price. I don't know if you have thoughts about it, but that's one of the things that I noticed. And I don't know if you're extrapolating that to the whole market, where the whole market can experience this kind of a reset, where we finally start to question, in general, do these stocks deserve that kind of valuation? Is that where you're going with it?
I think so, yes. And, it's something I struggled with myself, because you'd see exactly the point, like I mentioned with COVID, there's this train coming towards you. It's very visible and everyone ignores it. And if you reverse engineer why, it's because passive doesn't care what the company does. Like, if you think about it, like if we put $1,000 into Vanguard, the machine or the algorithm or whatever that executes has got no idea what Apple is. It's just AAPL, and it's buy so many shares at this price now, or in the auction. That's it. Like, it doesn't matter if the company sells phones or it's an AI or sells Vaseline. It doesn't matter. It's irrelevant. And I think that's kind of the issue with it, is so there's no pricing mechanism. It gets priced but not valued, if that makes any sense.
Yes.
And I think the issue, to your point, is that I watched this interview with these factor investors, and they were saying, they track 56 different factors through the year, and earnings is relevant for 8 days in the year. So there's about 255 trading days in the year, 8 days, earnings are relevant. And it's the day of the quarterly earnings and the day thereafter. The rest of the year, it's irrelevant. And I remember, the other thing that stood out to me in 2017 is JP Morgan said about 90% of daily trading decisions were made with no fundamental input. It is, changes in delta on derivatives. It is factor investing. It is passive flows. It is all those types of things. And none of it has got any kind of relation to the valuation of the business, the fundamentals of the business, changes in those. None of those things are relevant. So when you see large moves, it's basically just that the passive bid gets overwhelmed by people selling based on fundamentals. And it lasts only for a day or two, and then their influence disappears again. And then you go back to the machine. So I think those are the kind of issues that we're seeing more and more. So I would say at the moment, when you've got high valuations, because we're kind of definitely in the top decile of US valuations. If you're in this kind of environment, then your risk when it comes to results are asymmetric to the downside, because you've got this big passive bid, which probably took the shares away from the fundamentals. And if you then do get a recession or, just a business like, let's say, Nike or Starbucks or whatever that come up with results that's poor, the shares basically take a whole step down. And if they can't get back up again, then their weight in the index falls. And then it can become a permanent feature, thereafter, where all of a sudden they're not 2% of the index, but they're 1% of the index or whatever the numbers might be. And now they're getting significantly less flow, and that's kind of a problem. So, yeah, I definitely believe that. I think that you get more you'll get little stock bubbles and stock crashes, and you also get market bubbles and market crashes more often as a result. So the irony of it is, for most of the time, the market's actually super stable and the volatility is actually quite low, because you've got this consistent broad bid across 500 stocks. But then, what it does is it takes the equities away from their fundamental value, and when the individual company reports, that gets expressed obviously on the day and the day after.
So I have a couple of related thoughts. One, I see stocks that were highly desirable 2-3 years ago. They dropped out of the major indexes, and they completely disappear from the headlines. And their stock prices are stuck, like range bound, completely forgotten. Nobody really cares. I'm not going to mention any stocks, but there are stocks that used to be in the headlines. They fell out of the benchmark. I can count at least 5 that I looked at out of curiosity. So there's this fascinating phenomenon that back in the day, you would have, a sell-side analyst following a stock, and then a lot of people would drop coverage. And at some point, they would fall into this interesting bucket where nobody would really follow them. And you could actually find things that are interesting. That was a phenomenon maybe 10, 15 years ago. I don't know if that happens today, maybe with very small companies. Now I see this phenomenon with losing the membership in the club, as in the index. And then we forgot you. You're definitely not part of the regular buying that you talk about. So I find that interesting. And you pointed out volatility. I don't consider volatility as risk. I consider this as something that definitely impacts people's psychology and emotion. I respect that. I know that. But to me, risk is permanent loss of capital. I bought something at 100. It was actually worth 50, and I walk away with 50, and there's nothing I can do about it. Waiting longer makes no sense. I was wrong. Permanent loss of capital. And I'm lucky if I walk away with 50% loss. That's right. So that's how I look at it. In between the volatility, it gives you really no information, but we both know how much theory and research and studies and even academic teaching these days is still around volatility being a measure of risk. And actually, the more you have passive participation, I think the less that volatility tells you anything, because everybody is just buying. Anyways, do you have some thoughts about those stocks that drop out and how volatility is a lesser and lesser gauge of anything in this new world?
Yeah, I'd say where the volatility is relevant for me is it gives you a feeling of calm, when the volatility is compressed, which gives you, in my view, a false feeling of calm. So when we have this kind of discussion, you are open-minded and interested in the topic. Most people do not want to have this discussion with me.
That's why I
because
wanted
it
to have you on
feels
the show.
so good. I mean, the CFA Institute definitely doesn't want to have this discussion. And I think the issue with it is like, if things feel so good, why would you worry about it? Because it's got
Exactly.
to feel bad before you should be worrying about it. That's
Right.
kind of, I think, our general, just maybe that's a kind of an inherent thing in humanity. So that's my point on volatility. I agree with your point. It's not, I don't think the risk is the volatility. It's more the issue of, if it gives you a false sense of comfort. Like, I'm not sure if you're aware of the XIV, which was this inverse, VIX ETF. It shorted volatility every month.
Yes.
And it went from, I don't know, $5 or $10 to $110, and then all of a sudden disappeared in a single day because it became so large and people are so comfortable shorting volatility that when it blew up in 15 minutes. And today, short volatility is a multiple larger than what it was in 2018 when that blew up. And that's another issue where this, the low volatility, low rates changes our behavior because it gives us a false sense of comfort. And I think that's why it'll be such a large shock if you do end up one day where the market goes no bid. Like, people won't know what to do. It'll feel like what March 2020 felt like, or maybe early 2009 felt like. Then to get to the shares, I mean, I think the issue with like, if you think about debit order, monthly inflows into the market, if the money was going into a active fund, the active fund may have 50 shares instead of 500, or it may have 75, and it'll tell the stories about the companies and the like, and it'll look at anything that it thinks it can make money out of, where it's too undervalued. So somebody will come searching. It's a little bit like we're always on a search party. I mean, one of the great fun about this game is that you're always looking for something interesting that other people aren't thinking about. It's like a 3D global chess game. And that's, what I love about it. Like, it's, it's always changing. There's always something different. There's always some opportunity somewhere. And, when it's passive, no one's looking. All they're doing is inflow equals buy everything in the index, done. No thinking. So the market's becoming a less thinking machine. And then what that does is, the active participants that remain have to be quite smart to stay in the game and to outperform. And I mean, I've fortunately not competed in the US, but I mean, in the rest of the world, we've, managed to outperform the index and stuff, because there are behavioral things you can use, or different time frames and the like, to outperform or look for specific types of companies, that can help themselves and so forth. Where in the US, obviously, everyone's just basically in the index, and the ones that aren't, because indexing is so big, you have to basically, like you said, closet index, or you need to find ways to leverage up the index. And that's the only way really to outperform. So you'll probably find that a lot of the hedge funds will be, over time, they'll be, double weight Nvidia, which might be 15% of their portfolio versus 7 or 8% in the index, to get the outperformance. So those are the kind of things I think that happen. And, if you're not in the spotlight, you don't exist. It's a little bit like a social media world. You're either a meme or you're nothing. It's, and if you're not a storyteller as a CEO, I think your shares trade at a discount, because if you're in the index, you get the kind of weight in the index, and then the storytelling can give you a premium rating and give you a larger weight in the index. And then you can place shares. Like, one of the things I would do if I was the CEO and I was Machiavellian, I would just do paper deals and issue more shares so I can get larger and larger in the index, and then the index can take me up. And I'm pretty sure that there are people who do exactly that, because that's kind of the way you game the indexing system. Issue more shares. Like, we used to always believe that acquisition should be done with cash because it shows discipline.
Right.
And, that you'll only go into debt if you really thought about it hard. And paper was kind of a cheap way of doing it, by issuing shares or stock. And then, like in an indexing world, it actually makes a lot of sense to be doing stock deals, so you can get your market cap up, get your weight in the index up.
As I'm listening to you, I'm thinking of Ben Graham. And Ben Graham gave this testimony in front of the Congress 70 years ago, maybe 80 years ago. And they basically asked him, how does the market work? How come it works? And obviously he had this anecdote of the market being a voting machine in the short term and a weighing machine in the long run. And paraphrasing here from what I remember from that testimony that I read a while ago was that, somehow the market eventually discovers the actual value. It might be wrong for a while. And if you buy, and he was buying what he called, the 50 cents on the dollar kind of deals, eventually the market catches up, which is the mean reversion that we talked about briefly earlier. But I think the point here is that for the market to work, you need to have certain ingredients, just as with weighing of that bull that we talked about. If you take that ingredients away, by definition, it won't be a working market. And I'm avoiding the word efficient because the word efficient, I think, captures something else and confuses people. I think, to me, efficient, the way I understand it, is that today you and I are arguing about the price, not value, of, let's say, Coca-Cola, right? And we have a liquid market in the US in the shares of Coca-Cola. And efficiently, all the buyers and the sellers for today will meet, trade, and there will be a price that will clear all the shares. So it's efficient in that sense. But that's it. You said you separated the price and value at some point in this discussion, which I thought was brilliant and very important. Because yes, we got the right price, but we have no idea about the value. And the market can be wrong about the value for a long period of time. But Ben Graham had this hope that as a diversified working system, eventually it will tell us, this is $1 worth of assets or business that you bought, not 50 cents. And here you go, you have $1. Now, for those stocks that fall out of the index, and I'm just picking here on one little sliver of the problem, but they might not be recognized for longer than a lot of people can wait. And especially if you're managing other people's money. If anybody has ever sat down with a client who's looking down the list and there's this stock that hasn't moved for 3 years, well, I encourage you to convince the client that the stock still belongs in the portfolio. That's something that's not taught at school, but it's a real thing. Why is it still in the portfolio? Look, it's been 3 years. People forget the fact that, the Googles and Amazons of the world had periods of 3, 4, 5 years when they were dead money, but that's a separate thing. But that also tests your patience. I'm thinking about, we have a problem here, and how do we compensate for what's happening? And one of the thoughts that I had as I'm listening to you, there are all kinds of index funds or passive funds set up these days, and some of them are called equal weighted. And I'm thinking that if you do want to have the same participation, and let's take active out of the picture for a second, it's something that I do, and I understand that's something you do, and that's where your heart is. But if you wanted to be passive, do you think that equal weighted index is kind of, a halfway better solution, that you do have the exposure, but you're not part of the problem in the sense that you're not so concentrated in the top 5, 10 positions, but you really spread it out? I know it's not perfect, but is that something that could help take away some of the risk here?
I think it would, because it creates a certain counter-cyclicality, right?
Right.
Essentially, what you're doing is you're taking the things that have gone up the most and you're shaving it off to bring it back to equal weight. And you're reinvesting that money into the rest. So you're broadening it out. So you don't get a situation where a company just goes up and up and up and up and up and up forever. So my guess is, over the long term, when you've got more monopolistic businesses or oligopolies, things where lobbying and so on are protecting them, and they generate a lot of cash because they're functionally stealing our data. If the NSA did it would be illegal, but they do it, somehow they get away with it, and like that kind of machine just keeps running. They kind of compound away. So you would basically then be under positioned, obviously, in Meta and the like. So that's kind of what you'd give up, is that kind of compounding effect. Now, if the whole market was run that way, I think it'll be quite interesting. Now, you can say, well, the difference between, if we did it today, the largest company in the S&P is probably $4 trillion. The smallest one is 16 billion, 15 billion, somewhere around there. So if we had to do it today, that 15 billion company is going to quadruple at least, in the process of reallocating money away from the 4 trillion companies. And I think that kind of Pareto law makes it quite difficult to actually execute on this. But if we can get people to do it, just give me 2 days notice. I would love to own the bottom 100 shares in the S&P 500.
Well, truth be told,
I think conceptually, I think, it's something that could work. I mean, in reality, Could we execute it? It feels to me a little bit like AI. We're on this train. We didn't choose to be on the train, but this is the train, and no one is questioning where we're going, where's the track going, like, is there a cliff somewhere down the future? How's all of this going to work? And the people driving it are good storytellers, and I think that's kind of the problem. And they're also very directly involved in the regulatory process through lobbying and the like, to protect their position. So I'm not sure who stops it. I mean, I tried to do it with the CFA Institute last year, and they laughed at me basically. And then I said, well, can I speak to somebody in your government's department? And they said they'll set it up, but I never heard back. So, so I'm not quite sure who's going to be doing this. I mean, I'm happy to speak to people about it, and Mike Green speaks to people about it all the time. Mm-hmm. And I know he's got some studies. Harvard's done some studies for him, to prove some of the points, that he's made. But there's not a lot of uptake. It's not like if you had to like tally up the success of the whole process, it's not been very successful. At the moment, it's very much, passive is definitely, just growing.
I see it as a blind spot. And in my 20-year practice in investing, when I notice a blind spot, I want to understand it better. Because just being aware of it and asking questions and trying to figure it out, I think I can identify better certain risks that we might not be paying attention to. And from the day one, when I had my early interview to accept an investment internship in New York, I asked my future business partner about everything that can go wrong. And it never left me. When I look at investing, it's not that I'm pessimistic, quite the opposite, but I want to understand what can go wrong first. And then let's get excited about the upside. And here I have so many questions about it. And I'm so glad we're having these conversations because you have given it so much thought. And you point out all the challenges with, at the beginning, a pretty good idea. It's just that there are consequences to even a good idea. And I think it's very important to understand how this whole mechanism works, especially if more than half of activity or ownership is in passive. And we haven't even touched on the fact that for the business to do well, it has to have an owner. An owner, not just in the sense that it's something sitting in a retirement account that you know of, but you have really no influence or even interest in it. Ownership in the sense that somebody's paying attention, like somebody's actually watching, voting proxies and deciding if this management will take the business in the right direction. And so it's not just the price, but it's also the actual direction of the business. And there's so many companies that I know these days that the largest shareholders are the index firms that you brought up. Well, who is the owner? And not just in an economic sense, but in kind of, thinking sense of, I disagree with what the management is doing. That kind of sense, questioning the policy. And if you don't have that element, I think some things are happening that might not be beneficial in terms of allocation of capital, allocation of efforts, and then so on and so on. So I think it's a multi-layered question with very deep consequences that I think it's worth talking about and understanding. And it's hard to be in denial of it and saying, I only own my stocks, I don't care. Because if those stocks are in an index, they are influenced by everything that we talked about today. And you have to acknowledge the fact that, yes, they're going up for the reasons that you thought, but they might be also going up because they are the top 10 position in an index. And you might have even not know it, but it's worth knowing because it has a bearing on the price of that stock. Nick, I could keep you here all day, but I have one last question to close our discussion. I ask my guests about their definition of success, whether you want to talk about your passive index, research and study, or life in general, or your professional pursuits, however you want to take it. But how do you think about success?
I think to have some level of purpose in what you do, so you get meaning out of work. And I think if you enjoy it, it's not really like work. If I wake up at 4 a.m. and I'm looking at markets and thinking about these kind of things, it doesn't feel like work to me. So I like, that's something that I like. I think the next thing would be to have, confident children, that can deal with that are problem solvers and can deal with issues as they grow up. I think that would be a measure of success. And then having some deep friendships, people that you've known for a very long time that know you and that can say, wait a minute, disagree with you, you think, you're like this, but you're not. I think we all need that kind of, I think all the Harvard studies have shown, that relationships are really, really important. So investing a bit more on that, I think, would be a level of success. And then, as far as purpose is concerned, I mean, I joke, making active great again is something that I'm really interested in.
Mm-hmm.
And so for whatever funds I'm involved in, for that to be the case, I think is important. So, I mean, just to go back to your point about passive not really caring, one of the active managers I work for, they vote on every single resolution at every single AGM. And they speak to the analyst, and the analyst will give his input against this, for that, whatever it might be. And I think that's kind of the world we need to get to, because when no one's really looking, a lot of bad things can happen. The Wall Street Journal, for instance, had an article last year that measures of accounting fraud in the US is at 40-year highs. Now, that's what happens in a world that's really passive, because no one is looking. And, we've got this perception that American companies are the best run in the world and the most honest and best legal system and the like. But the trust in the Supreme Court is like the lowest I think it's maybe ever been. And if you've got accounting fraud potentially up at 40-year highs, what are we doing? That's not really the outcome we're trying to go for. And I don't live in the US, and I think we want the US to look like the shiny city on the hill.
Mm-hmm.
It must be something we look up to, because there are many other places we don't want to look up to. So I think it would be better for the system to work a bit better.
One last thought that I have, just hearing you share that, is, anything that can't go on in life eventually stops. And that's what I've noticed in investing, that trees don't grow to the sky, and however you want to frame it. And I feel like this is bound to snap in some way, this overweight of passive participation. And once it does, I hope we still have enough people who are trained and competent, active investors out there, because as a species, I think it's a shrinking, if not a dying breed. I think that's how I look at it. A lot of people are just giving in and giving up on the idea, and there are a lot of boutique firms and very smart people that I know that are still doing it. But in terms of percent of assets, it's not a lot. And once it snaps, I think that's going to be the moment for those that actually know how to read an annual report and know how to evaluate a business, and even know how to ask a thoughtful question to the management, which is not that easy if you actually want to ask a question. I've been in rooms where everybody was asking a question about the next quarter, and I was the only one in the entire room that asked about the next 3-5 years, not even a decade. And the CEO asked me to stay and talk to him a bit longer, because he says, nobody ever asked that question. Why do you care? And I thought, that's the conversations I'd love to have. So I feel like it will snap back at some point. Maybe I'm too optimistic, but nothing that can't last forever will last forever. That's my mindset here. So I'm glad we talked about it, and I'd love people to be more aware of it. Passive investing has helped a lot of people participate in investing, of course, but I think to be aware of all the consequences, I think it's very helpful, because it can be a growing blind spot for too many of us, and blind spots are a dangerous place. So let's be aware of what we're not paying attention to. Nick,
it's a pretty big one, and like you say, it probably ends with a snap rather than with a whimper.
Exactly. And I'll be thinking a lot after this conversation how to prepare for that snap, and I have some thoughts about it, but I think that's something that everybody should keep in mind. How do you prepare for a snap like that? Because it will be I think we'll use Jack Bogle's words and call it a chaos that would follow if it happens and when it happens. Nick, thank you so much for today. This was wonderful, and I really appreciate all the thought and research you put into this, and that you decided to share it with me and my audience. So thank you so much for today.
Thank you very much for your time. I really enjoyed it.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank Thank you. Until next time, your host, Bogumil Baranowski.